Alrighty, so here we go. Again, I'm Steve Hodgson. Hi, and I run a little business called Modern Asset Management. We're primarily a lender, but we have a fair number of real estate holdings, primarily single family. Um, the last big project I did was a large strip center um, in Denver that I bought at the beginning of the crash, just before the crash, and after coming out of that successfully, decided that I wanted to go small, and I own a pool of the company owns a pool of a couple of dozen notes. First trustees performing, and we're in the midst of a handful of foreclosures, and we've got some single family rent own projects that we've done in Florida where we've got good boots on the ground. With a company called Sunrise Acquisition Services, and uh, and so I thought, because this is what's been on my mind lately. That's what I do. Is about once a month I open up something and I talk about what I'm thinking about. So this is I'm going to talk about joint venture and LLC investments. Um, and I want to make sure we understand that I am not a lawyer, I'm not a legal expert, I'm not a tax attorney, I'm not any of that good stuff, and that this is not a solicitation. I'm sharing my experience, and I'm looking for feedback and people to share what works and doesn't work for them. Um, so, oh, look, and there's Nick, and he's in the car. Hey, Nick. Um, and so to start with that, I said we've got 6 people on the call, so let's just get going. So like I said, I'm going to show you what I'm thinking about. I'm going to break down one deal that I'm in, um, to give you a sense of that. Um, let's see. I can get rid of Nick's camera right now because we're looking at the ceiling of his car, I think. So this is called joint ventures and LLC investments. And so this is a mobile home park investment that I put took a small position um, in July of this year, and it's in Middle America. It's in Wisconsin. It's a rundown, kind of crummy park, and I like things that are value add. I like things that we can make better. Um, so, excuse me. So this was a purchase that was $3.3 million acquisition. Actually, it came in a little bit less than that with some last minute concessions by the park owner. Um, the group that was heading it up, which is typically I'm the syndicator, but I wanted to talk about a deal where I was the passive investor. Um, they arranged a mortgage-backed security loan for $2 million at, I think it was 4.6%. They took $1 million from a venture partner, an equity position, from a larger park developer, some folks here in San Francisco called Park Street Partners. They gathered $1 million from 14 investors, including me. So they raised a total of $4 million and bought a park that was 3.2, something like that. Closing costs, due diligence fees, 2% fee to the originator, which was them, the general partner, left them with about $500,000 in working capital to start rehabbing this park. This is the way I like to look at doing retail strip center rehabs. I've done some apartment kind of work, fourplexes, that kind of thing, and I like to go in having the cash needed to do the work and not have to come back to investors later for money. So um, So in these deals, this was a position in an LLC that then controlled the LLC that bought the park. So there were two LLCs that were co-partners, and so I'm part of the group that has half the park basically. So they created two share classes. They created an A share for the investors. That was 70% of the equity, and a B share for the operator, which was 30%. So for doing the work, they get a 30% reward of the profits of the park. They guaranteed isn't the right word, but they guaranteed. They provided an 8% preferred return to the investor, and that means that I get 8% before they get anything. Then they created a hurdle at 14%. So from 8.1 to 14%, there's a 70-30 share of operating revenue from the park. Right now, the park's making, I think, about $7,000 or $8,000 a month cash after expenses. And once they clear that 14% return, then the revenue goes to a 50-50 share. Now that clearing that hurdle is likely going to occur when the park sells. So they're really geared toward improving the park, making it a better, more stable asset, and then selling it to somebody. The operator also gets a 5% of gross revenue for management. So if the park collects $30,000 a month in rent, then they pick up their $1,500 of that for doing the work, plus any expenses that are incurred. So it's presented to you as a 70-30 share, but after you start looking at these different numbers, it's not really. So most joint ventures work their way down to be in somewhere close to 50-50. I've been in some that start up top at 75-25. I do the same. I do similar things like that. You can do a 90-10 deal as long as the operator gets enough cash flow to actually be able to devote the time and attention to doing the work. So this was, like I said, this was a value add strategy. It was a park that wasn't operated by a mom and pop. It was owned by a big park holder, somebody that owns more than 200 mobile home parks, and they've been improving their portfolio, going more into A class and senior parks. And this didn't fit their criteria. It's not in an area that's seeing a lot of increase in population. It doesn't have, as well, it's got a college and a couple of hospitals. It doesn't have a lot of economy there. It's just a mobile home park in middle America. So the park was run down. They had a lot of vacancy, and the rents were below what the competitors in the marketplace were charging. So there's also several acres available and pre-approved by the city and county, I believe, to add 30 more home sites. So that would take them from 180 now to 210, and that's where they see the real improvement. It's it's like building another wing on an apartment building. So they immediately went out and repaved the roads and did a lot of repairs and spent just about most of that $500,000 in the first year, or are spending it in the first year. Yeah. They also inherited a bunch of park-owned homes. They sold those to tenants. They're bringing in some new and newer models, so some better used homes from the 2000s. Day one, they raised the rent 10%. Had a couple of people leave, but people knew that they had a great deal, and so they were okay with that. They turned over on-site management twice in the first year, and they're happy with the crew that they've got in place now. The park is, it's been paved and painted, and it's simply a nicer place to live. And it's cash flow positive right from the beginning. The advantageous terms of the loan, not going too deep in debt to income, has allowed them to make the first two quarterly payments to the investors, and they've been right on target. So if you were going to do something like that, here's a couple of things that I'm considering. And again, I'm gonna, I have deals. We look at deals every week, and this is not a solicitation. I say that again and again. We'll look at these two. Nick's going to share on a third that we're actually in the middle of. But it shows you just the kind of things that are out there. And the first is Southern California, small multifamily, $1 million and change purchase, a fourplex in a beach town, but not on the beach, down in San Clemente, I think this was. At purchase price, it was a 5 cap. So it just, what a terrible deal. Who in the world would buy a 5% investment? I looked at it as a value add. The units hadn't had, I don't think had anything done to them since the 80s. And this was 2 houses basically on a lot. So each house was a duplex. Had lots of beachy kind of character, and I thought had great upside. My intent would be to go in and remodel each unit, turn them over, make the place bright and shiny, and raise the rents from the below market $1,500 that they were at up to $2,100, which was market. So $2,100 a month. It's a big jump in rent and raises that cap rate considerably. My intent was to go out and get a hard money loan through the rehab, and then either re-tenant and flip it, or hold or refinance it with long-term financing. There's money for landlords anywhere between 5 and 7%, or simply this could have been something I could just put away and just hold. Another one that we're working through right now. We do work in Pensacola. We like that community. It's had a 30% growth in population over the last decade. It's got a good mix of industry and economy there. We have an experienced daycare operator looking to open another facility. We know the borrower. She's been a renter and then a mortgage holder of ours for the past 2 years and has never missed a payment. And she's looking for 4,000 square feet to open a daycare. She does adult in-home care now. She basically runs a personnel service. And we thought we looked at a couple of sites, and we looked at one that had that was 6,000 feet. It was a old dead little strip mall that didn't have anything happening to it. Could be gotten for $500,000, and we thought $100,000 renovation would make it just perfect. So that would be buying at a 10 cap. Looking for about a $5,000 monthly rent. And there's a 70% loan available on that property. And I got a first quote of 7.9, but I think that's really going to be a 7% number. And that one's got real interest, again, because we're repeating process that we've done before. So I showed you what my what I bought as a passive investor, and then I showed you a couple of examples of what I do as an active investor, where I'm leading the group. And
Steve, going back to the mobile home investment, were these operators that you were familiar with, or you had some kind of previous business engagement with that you trusted them, or you're familiar with the particular asset?
I was not familiar with the asset at all. I was familiar with the seller of the asset. I'd been to his training classes a couple of times, and so I knew that. I knew the seller. I knew the principal, who's running the project.
Mm-hmm.
He's a guy out of the Southern California circle of friends that I've made down there. Um, he's a contractor turned real estate investor. So he is very much into the nuts and bolts and what things cost, and that's his strength. I don't know his partner at all, but I get the sense from what I've seen, where the reporting comes from is they're handling the money side. Much like you and me. Much like you and me. As soon as we start to get into Excel, I go, here, you do it. And so, and it's like I said, it's one of those. Nick knows me really well, of course, and it's one of those projects that is as I hate, because there's nothing I can do to make it better. It's just let it sit there, do its thing. And it was a $50,000 investment, and I expect at the end of 5 years, when that cashes out, I'll have in total gotten back $120,000. And it's priced that even if you have a couple of point interest rate adjustment, it'll still be just fine. So, and one of the things that made that interesting to me is the CMBS loan is assumable. So it's a 4 and change loan that can be picked up by the next buyer. When I sold my shopping center, the cost to assume that loan by the next operator was egregious. It was just, they wanted like $250,000. It was outrageous.
For someone who is unfamiliar with how to underwrite a mobile home asset, what would be your suggestion? Obviously, the allure of the long-term cash flow from a multifamily like asset, but the individual assets, the individual properties themselves are sometimes a liability, right?
Right.
Sometimes they need to be removed, but they could actually be cash flow positive, but they're a liability where they sit. So how do you underwrite something like that to know that it's a good price?
Well, in the final negotiation that went on in that transaction, they threw out all the park-owned property. They just said, we're not even going to count those. These were 30-plus-year-old mobile homes that all needed work, and so they cost more to repair than sometimes to replace. The underwriting, the general underwriting is the classic things you want to see. You want to see prior year's history. You want to actually examine the rent rolls door to door, make sure there's somebody behind, a real person behind each lease. Why I decided this park was good. Rule of thumb that I like is there a new super Walmart nearby? Is there a hospital? Is there a school? Is there some sort of service industry in that community that'll support people that live in a mobile home park? The lot rent in this park is $300 a month, and so it's in an area that's close to a couple of schools, and it's a basic entry level kind of product. They're sprucing it up, and probably gonna finish at the end at $330 for lot rent. But a 30, they went from $280 to $300 to $330. So if they did that, that's $50 a month times 210 spaces. And the community can support that. I also look at crime in the area. I look at you know you don't need to go to Wisconsin to look at it. You can back up in Google Earth and cruise the neighborhood and see where we're at. We looked at a small apartment building in Marysville, California, a couple months ago, and when we Googled up and down the street from that, I was like, oh, no, this is not the right place to be. And there were rundown apartments on either side. There were, each side had a liquor store or a, gas station, convenience store, and lots of dead dirt, lots of chain link and barbed wire around big tracts of land right around this apartment complex. And so that was not the kind of place that I want to be. So
the C-class park, I think, as you described it on the first slide, introducing it, are there different similar to multifamily mobile home parks that are Class A, Class B, where the assets are not liabilities?
In the A ones, yes. Here in Marin County, a mobile home that would sell in Wisconsin for $30,000 will sell here for $300,000 because it's where it is, and it's got a grandfathered ground lease, So it's the other part. I guess the numbers part of mobile homes is I look at what houses sell for around there, and if houses sell for $100,000, then somebody's renting a mobile home for $600 a month can go buy a house. So I look for places where houses sell for a couple $100,000, and that brings me to Pensacola. That brings me down there, and we've been sniffing around Pensacola for a little bit too, and everything we've seen there has been too small, too run down. To make a mobile home work, you have to look at it like a mobile home park work. You have to look at it like an apartment building. You got to have 24 doors. You got to have 24 lots, and you have to have a plan to do more in the area, because park management is labor intensive. It's folks who, depends on what kind of park you have. The lower the grade of the park, the more drama, the more Jerry Springer show it is. So I wanted to leave this slide up for a second because it shows you that it's a 5 cap in California and it's a 10 cap in Florida. And if you don't remember what cap rates are, that's basically your percentage of return. Investment objectives, how and why, active versus passive. You want to talk about this for a minute, or you want me to?
Yeah, this goes back to the slide of everything you've done, and as Steve and I have joined up together, I'm getting the history and the why on a lot of the stories on how things came to be. So going back to the prior list, the Pensacola deals, why there were 5 cap deals and 10 cap deals in the portfolio, and what he's done in the past. There's always a reason or an objective that you're after, and I commonly come across individuals that want to invest, and there's a lot of questions I think I come back at them with that they don't have the answer to, and I'm asking, well, what's your time horizon? Are you looking for monthly cash flow? This one particular scenario just recently, a couple of months ago, someone who was interested in putting money up for our consumer loan receivables pool said, "Oh yeah, I'd love to invest in that. Like, what does it earn?" And then it turned out that that principal needed to be, well, it needed to generate some cash because there's living expenses for one of the individual's family members. So that principal needed to generate cash, and there were reasons that they needed to have some control. So Steve was talking about all of these um, active deals he was invested in, and active versus passive is what I was going to dig into a little bit more to just ground ourselves on why we're doing certain things. Our majority of Steve and I's days these days is centered around the growing the consumer lending business, and that is, I think Steve would agree and nod his head, very labor intensive, very transactional. When you're doing $2,000-$3,000 loans, it requires a lot of touch. So that is all the way on the end of the active scale. It is not passive at all. If we had a billing company and a management company in the middle, it could be a passive investment. But it's active enough to where it's a business. So the advantages to Steve investing in the mobile home park, obviously he was able to be hands off. He didn't have to touch the tenants, do any of the rehabs. The other Pensacola projects have obviously taken more of his time, and the other projects without a manager in place, like the development and or the multifamily in Marysville, would have required us to put the management in place if we didn't want to be hands-on every day, which we don't have the capabilities to do. So I I I go into this is the active versus passive terminology, I think, is common now in the equity markets, where certain active and passive funds just invest in other funds, and you're paying a middleman, but are you actually getting a higher yield at the end of the day? The active investments really allow you to be more proactive, take more calculated risks if you feel comfortable in doing that. But I think it really comes down to understanding the asset, and there's a number of guys that have like the 4 C's of investing, or 3 D's of investing, in your diligence and your discipline. In active investing is absolutely key. And one thing I think everybody would agree with is, when you're actively involved, you have the ability to create more more yield on your investment. However, you also have the ability to create losses. We're human. We tend to make knee-jerk reactions when we're not thinking about things, or we miscalculate things. So there's no right answer, and we're constantly asking ourselves these questions every day about how active or passive we want to be, whether it's ability to actually deliver on whatever the activity is, or whether it's being able to have someone in place that their time is we can afford to put them in there and it's cost effective.
Let me jump in there. Let me jump in there a little bit. So I talk with new note investors quite a bit, and one of the things that people tell me they want to do is they don't want to be passive; they want to learn. And you can learn by doing, you can learn by education, but the best way, of course, is to go out and and trial and error, but it can be expensive. And so I see folks that go out and buy non-performing loans without having any real estate experience, without having any collection experience, without being a lawyer, without being anything, and they wind up just not having success. So I suggest that people if they want to learn about the note business, that they buy a performing loan, because that way they get paid while they learn. They may not learn everything, but you'll learn plenty. You'll learn plenty. So one of the things I guess to look at, and I want to move us along, because I want to stay on time this time for a change, is, do you have a superpower that makes you better to be the active partner than a professional? In my case, I've got 38 years of debt collection experience, and now more than 20 years of commercial real estate and project experience. And I owned a property management business along the way. So I've got lots of hard knocks that I've been through that it makes sense for me to be active. If you're this lady who was a pharmacist, or no, she was a nurse, who had no experience and went off and bought a bunch of bad notes, and she's okay now, but it took several years to work through them. And so I just caution folks to find the right person to ride along with, or buy something that's performing right away. And the mobile home park jump for me fit that. I had never owned a mobile home park before, and this was a way to dip my toe in the water and buy something that was cash flowing immediately. I have a similar investment in a 250 unit apartment complex up outside of Microsoft in Washington. But let's move a little quicker, and maybe we can get to some questions. So there's a chat box that you can just type something in, and maybe we'll have a little give and take after we get some stuff going on. So, you're going to talk about Sunset Plaza.
Yeah. If you want to go to the next slide, the questions I posed on there were everything we just talked about. Just asking yourself what your time's worth, whether you can pay somebody to outsource that and have a better return on your time. The frequency of distractions, really going into something with the right structure to know that you're going to get calls from tenants, or you're going to have to make a buy or sell decision every single time, and having return expectations. Otherwise, you can work all day until work's done, but if you have target return expectations, which is another common missing piece, you'll be able to set yourself up for the right
what is it you're trying to achieve? Is it reasonable? Has somebody else done it before? And that's the caution to, there's people that are out there selling stuff or telling you you're going to make 50 cents on the dollar. Well, I just told you a deal that I think I'm gonna more than double my money, but it's 5 years, and that's a long time to be illiquid. I've got several real estate projects in the middle of the country that are now, they're foreclosures that are now in, one of them's 2 years that's been illiquid, where I haven't seen a penny on it, and it's just the borrower was really good at not paying their bills and avoiding all the steps in foreclosure. So speaking of
sometimes it's always the stocks you can't touch that are the private placement, the privately held stuff that ends up paying off. And you may have, if you could sell it through your E-Trade account, you may have made a knee-jerk reaction based upon news. And speaking about illiquid stuff, it kind of has to be held. This is a prime illiquid example. We've done a couple of these deals now and talked about a large project in Bel Air that's on the market for $7 million, and there's a new project that we took on since we've committed to since the last month's Zoom call. And there's a description up on the screen. The rendering is absolutely gorgeous. The site overlooks Hollywood Hills, and it's got all the bells and whistles. The project was a distressed, unique opportunity. There's a story behind it. The seller is going to be involved on the back end, so it creates a really nice, comfortable LTV for the first and second lien holder, which we've had the opportunity to come in as a second lien holder and put up money for construction. And this is an example of something that is illiquid at the benefit of really being able to learn. This is the second large luxury home new construction that I've been involved in personally. The new construction, being passive in new construction, something over the last few years that Steve's done a lot more of. But the business, what can go wrong, holding your contractors and your developers to certain timeframes, all that is over the last couple of years has been a huge learning lesson, and we feel that that's something we want to be active in, and even being illiquid for a year and a half. A lot of these with being in the right value position, it makes sense. So this is something that I think Steve might post online. We're raising some additional money to match or right along our position in this deal. And although we don't usually bring stuff like this, is a real example that we're learning with, and I wanted to bring to the group.
Right. So this is to jump in. This is not a solicitation for somebody to invest in this. I'm gonna go post this on on the marketplace at Bigger Pockets, where it would be a solicitation. What I like about this project is this is the third project of this scale by the developer. The last one is just beautiful, just beautiful. What I don't like about this is it's a $7 million house, and how many $7 million borrowers are there out there? But when you look at the total the out of pocket for this, it's a $4 million loan from the first. Call it a $500,000 second. So you've got a $4.5 million position to be whole on a property that's worth, if they're going to ask for 7.5, it'll sell for 7. If it sells for 6.5, everybody's happy. Everybody gets paid. The big risk in all of these things, and again, the first word there was illiquid, is time. It's time. We get a little blip in the economy. We get a little blip in interest rates. People pull back. You have to make your own prognostications on as we're all amateur economists on where we think the wind's blowing in the real estate market. We think being in LA, and Nick lives in LA. Some pieces of dirt you stand on, and it's the right piece of dirt. And this is in a high demand area where the neighborhood is going through this revitalization, where 3,000 square foot houses are being torn down and 6,000 square foot mansions are being put up in their place.
The lots are condensed. The properties are for comparison, I had shared with Steve the property next door to this had refinanced for $1,800 a square foot, which is just mind blowing to anything that we've ever played in. This is the expectation on this is a lot lower than that. Our basis will be less than half of that, even in second position. So the metrics all around, even for a downside, for some downside in the economy, all pan out. But the market is hot.
Mm-hmm. Yeah. Well, and on the flip side of this, the the other loan that we're going to come out to market with is a whole whopping $55,000, and that's for a whole house. So, and that was a house that we remodeled in Pensacola, and the tenant, now borrower, hasn't missed a payment in 2 years, and I held on to that because I wanted to. It was part of the learning is let's ride one out past the past the dates where people fail. People are going to fail on a small seller finance loan. They're going to fail in the first year. And the other part is making sure that they have equity in the deal. And we had to wait for this borrower to gather up some equity, and she now has I think something like 15% position. The house is worth 80, and this loan's 55. And so, so let's see. Back on the Zoom group, looking for questions. Like I said, I'm trying to keep us to the hour, and we're at 45 minutes right now. Like I said, we're just two guys in the real estate and mortgage loan business. So we're not gurus. Nobody's selling a program. Nobody's trying to we're trying to share stories, and it's and so. If any of you have something that you've been happy investing in that you want to share with the group, let us raise your hand and we'll open up your microphone, or you can open up your own microphone. Anybody gotten burnt? I've got some of those horror stories. Maybe we go into tenants in common because I like owning the real thing, not the LLC. And where do you think we're going, and what would be a hell yeah? So you can unmute your microphone, or you can type in the chat box, and we can have some communication. This group seems to be quiet compared to last month. If we don't get questions, I'll be forced to tell my health savings account story again. I promise I wasn't going to do that this month. So, yeah. My wife was happy. She got another payment in her HSA today. So. Questions? Going once, going twice. How about funds like PPR? I think Dave Van Horn is a really solid individual, and I like what he does. I like what he does. I've been through what I really love is he gives away tons of really good education at a site called PPR Academy. And Dave does a little bit of this and a little bit of that, and he was really, really heavy into seconds, and is now now diversified a little bit. So I didn't get into seconds because I'm now in my 38th year as a debt collector. And 3 years ago, when I shifted from buying unsecured paper to buying mortgages, I decided that I wanted to stop running a collection agency. And so I didn't buy seconds. Seconds is all about delinquent seconds is all about the debt, all about the debtor, and not much about the property. So I didn't. And looking back on it, I probably should have started in seconds because that's where my skill set would have transferred the quickest. And I said, I like Dave's stuff. I like roof stock for individual assets. There's lots of small investment, like $1,000, $5,000 minimum. Peer-to-peer lending platforms that are doing real estate. I don't know. I don't know if Dave's fund was in business in the last crash. I don't think so. I think he got his launch because of the last crash. Dave, for anybody who doesn't know what PPR does buys defaulted second mortgages and either works them out or forecloses, and they keep them in a fund. I like that he offers to buy, let you get out if you need to get out, if he has another borrower, another investor to come in and take your place. I like I like investments at Fairway America down in San Diego. They have some mobile home park funds. If you're looking for passive, where you're just, where you're one guy among hundreds. And so the note is, Jim says that PPR says he's paying 12% for 3 years. It does seem like high interest for passive, but the slide that I just put up there was, that Nick put up there was 15% for a year. So there's deals out there. There's a perception in seconds that you're kind of out there in a high wire act because you're naked in a lot of those loans. There isn't equity coverage, so they really are unsecured loans. Nick spent 10 years in the distressed unsecured world, where we would buy paper for 5 basis points. So that's 5% of 1%. And I've bought lots of paper at 3 cents on the dollar. And now these unsecured second mortgages are trading for 60 cents. So I don't know. If he's paying 12%, when I look at my numbers, in order for me to pay 12%, and I do pay 12% to a handful of investors, it's in product that we're making 25%. So back to the floor. Any other questions? So we're around. The email addresses are at the bottom. And you can reach out to either of us if you've got any kind of questions. If there's anything you want to learn about, we've got a pretty good library of all the literature that's out there. I'm regularly shopping a portfolio of performing mortgages, and we're looking for partners in transactions in Florida for single family and small multi. Yes, and Dave Van Horn did just put out a new book. Also, Martin Sines has a new book. I really liked Gordon Moss's book that he wrote maybe 10 years ago, the one that got me turned on to the idea of playing in mortgages was a book called Invest in Debt by Jimmy Napier that was written back in the 80s. Dave Van Horn's book is on Bigger Pockets. He's really active on Bigger Pockets. He's got a couple videos that he's just put up there talking about from a beginner level, what are notes, how do they work, all that. And like I said, I think Dave's a solid guy. And I also put a plug in for Bigger Pockets. I have found that community to be just a wealth of information. So.
It could be a good future topic in the next couple months is to do a meet up on just those items.
Mhm.
Sounds like there's a lot of interest.
Yeah. So, okay. All right. So going once, going twice, going 3 times. All right. And I want to thank everybody for coming in. We'll go put this up on YouTube if you want to find it later, and it'll be a link in the meetup channel. Please feel free to share it with anybody that interested. And we are always looking for topics. All right. You got something you want to talk about? You got a deal that's sideways? You got just want to talk real estate or notes? We're that's that's all we want to do is just talk about work. All right. So thanks to all for signing in, and we'll see you next month. All right. Okay. Bye-bye.
Thank you.
All right.